Welcome back, Vetted VA. It is Tuesday night, and every Tuesday we get together with 2 or 3 of the expert mortgage and real estate moderators from the group, the folks who answer your questions every day in the forums. And our primary purpose here is to answer your questions live. So if you have a question, mortgage or real estate related, VA related, non-VA related, anything that we can help you with information-wise, throw it up in the chat. We will get your questions answered. Tonight, what we're going to be talking about is common mistakes in the home buying process. So both things that your lender and realtor wish you knew, and things that we hear commonly that home buyers wish they knew a little earlier in the process. So with that, my guests tonight here on the top row, Jeffrey, I did not get the correct pronunciation of your name. Is it Wyttenbach? Is that the correct pronunciation?
Yeah, you got it, man.
Lucky, beginner's luck on the first try. Yeah. So Jeff, you are a loan officer here in Ventura, California, same neck of the woods here on the West Coast with me. So you're enjoying our wonderful rainy weather. It's funny, this is like the 3rd or 4th week in a row, which is very uncommon for us in California to have to be complaining about the weather every week for a month straight. On the bottom row here, I've got Shanequa Jones, a realtor out of Houston, Texas. Thanks for joining us tonight, Shanequa. And then our last loan officer expert here is Nicholas Framarini. Did I get that right?
Yep, that's it.
Perfect. So with that, let's just jump into it. And we'll start with you, Jeff. What are some of the common mistakes that you're seeing buyers make, borrowers make, and that you wish they knew earlier in the process to make it a smoother and easier and better process for them?
Just starting the loan process and the difference between a pre-qualification and a pre-approval. So there is a big difference with the pre-qualification and a pre-approval. So starting the process and knowing the difference is kind of crucial, the kind of kicking the whole real estate adventure started. So
what do you see? This is a big one. I hear people all the time, no, I've already been pre-approved. I talked to a lender. And then I get into the process and start talking to them and they go, well, they saw all your documentation, right? Well, no. We just had a phone conversation and went through it. Why don't you tell us what a pre-qualification looks like? And then more importantly, when you're pre-approving a borrower, what the conversation looks like, how that process goes, and why that's more beneficial for a buyer than that basic pre-qualification.
Yeah. So pre-qualification, anybody can get pre-qualified within, minutes. It's a simple phone call. Online application. It's simple. How much you make, what are your bills, what are you looking to buy? So, hey, I make, 100 grand a year, take that divided by half, that's 50 grand divided by 12, take off some debt. Hey, you got a car payment, credit card, kind of subtract that. And then there's your pre-qualification. So I just did a pre-qualification on a $100,000 a year buyer. And that's it. A pre-approval process is actually verifying all this information is correct. So you're going to submit you're going to submit W-2s, you're going to submit bank statements, income and assets are going to be verified, credit's going to be pulled, and we're going to wrap all that up and give you a pre-approval. And that's a true pre-approval, different from a pre-qualification.
So in a perfect world, we'd all love to spend 3 to 5 minutes talking to a loan officer and know what we qualify for. But The reality is, without that documentation, it's kind of garbage in, garbage out. Shanequa, from the real estate side, if someone goes to a realtor, one of the first conversations that you guys have is, have you been pre-approved? And if not, let's work on that process. Why is the pre-approval so important for you from your end in working with a buyer and making sure they get the successful outcome that they're looking for?
Because for one thing, you don't even know if you're able to buy a house. So why are you looking and, God forbid you can't buy a house. So you just wasted all that time, got your hopes up. The second reason is you don't know what price range you're looking at. I can say, well, I think I can afford $350 based on some calculator I found online, but until you get everything verified, you don't know that price range. So it's good to just narrow it down just to make sure.
One of the things that to me is super critical about this process, and it always shocks me, probably once a month, I talk to someone and they say, yeah, I've been pre-approved, and they legitimately were pre-approved, completed the application, had credit pulled, provided their income and asset documentation. And then we say, Well, do you know what the payment was at a $500,000 purchase price? Do you know how much you need to have in cash to close? And especially with veteran buyers, VA buyers say, well, I don't need to put anything down. There's often some confusion with that. So to me, like the most important outcome you as a buyer get is, yes, I know that I can be pre-approved and I have a ceiling on what I can qualify for. But most importantly, what is that payment going to look like? Especially with the VA loan, you guys know we can get most veterans approved for far more than what they're comfortable with. We don't have, if they're meeting the residual income requirements, most veterans will qualify for a very high debt to income ratio, probably higher than they're going to be comfortable with. So we want to get the veteran the information on what is the max you can buy, what does the payment look like, and how much cash you need to close. Nicholas, do you kind of want to walk us through that and kind of that misconception sometimes among some veteran borrowers, especially first time, hey, I don't need to put any money down, so I don't need any money. So maybe walk through what cash to close looks like, and if you don't have it, how it can be okay and how you can work through it.
Yeah, so I know on our side, one of the things we definitely focus on, as you mentioned, when we do that pre-approval process, we're, instead of me asking, hey, what's your ideal purchase price, I always say, hey, what's your ideal payment? And then let's reverse engineer that so that, it's a lot easier for us to figure that out than it is for the veteran to figure that out. So I totally agree with you where you're coming from on that, where it's most of the time, how comfortably is the payment versus how high we can go because of how much, there is a lot of wiggle room for the VA. But yeah, when it comes to the cash to close, I think one of the biggest misconceptions is, I don't need any money. So you're always going to have closing costs. And depending on your state, depending on where your purchase price amount is, that percent's going to range. I know we're in the DC area. It ranges usually from, 2.8 to 4%, depending on your purchase price, depending on the type of property. And so, in addition to that, you're also going to have money. You're also going to have things that come up after you move in, right? So you're going to got to furnish the house. You got to make sure that you're aware of budgeting for potential future repairs. And so one of the biggest conversations that I always like to have with the client is, it's not just about the cash flows that you need for the transaction, but also is making sure that you're aware of that afterwards. It's important to have some funds left over. From a lending standpoint, what we're focused on is verifying that you have enough funds for the required closing cost. So that's all we do have to verify traditionally, unless there's some other parameters that may require reserves. And then, along with you paying for them yourselves, you can always try to negotiate for a seller concession. And that's where the seller will give you some money towards your closing costs. Obviously, depending on your marketplace, depending on the level of competition, that will dictate how available those are for you. Your agent, will be able to advise into that as well. But, those are going to be your two main ways of paying for it. There are some situations where the lender might be able to chip in and give a credit back through a lender credit. But those are kind of generally the three main ways that we see the cash to close being covered, is either through the veteran, through a seller concession, or the lender giving a credit back towards their closing costs as well.
So did I hear you correctly? In your market in Maryland, you're thinking somewhere 2.5% to 4% is what someone should allocate for their total cash to close. So closing costs plus their prepaid items, taxes, insurance, those things.
Yeah, I think it's always tough because if some of the fees are flat fees. So, if you have an underwriting fee, or the title company will have flat fees, recording fees, flat fee. Some of your fees are flat. So if you buy $1 million home, your closing costs are probably closer to 2.5% in the DC area. However, if you buy a $200,000 home, your closing costs are going to be closer to 4.5%. And I think one of the biggest reasons that I'm always, an advocate for just have that conversation with the lenders sooner rather than later is because if you Google what's the average closing cost, you're going to get a number that's probably not going to be accurate, because that closing cost figure is going to, definitely be so different depending on your purchase price because of some of those fees being fixed flat fees that aren't tied into your purchase or loan amount.
And kind of the reason why I asked, I'm in California. We only do loans in California. I know a lot of people are licensed in multiple states, and regionally, you will generally see closing cost levels similar. What you're saying there in Maryland is a little bit higher than what we see here in California, but it's important. Like you said, it's hard to Google and say, what are my closing costs on a VA mortgage? Because we got 50 states. Some of those states, we vary a little bit between Northern and Southern California of what that's going to look like. Shanequa, you're not necessarily dealing with loan estimates and disclosing those fees to borrowers, but you're seeing settlement statements. You know what it looks like. For you in Texas, What do you generally prepare a buyer for with a range of a percentage of what they might expect in terms of closing costs?
If they're 100% disabled, I tell them their closing cost is going to be around 2%. If they're not 100%, it'll be about 3%. But I tell them this is just a general estimate, but make sure you get with your lender to actually narrow down that amount.
And Jeff, would you say that's a similar number to what you quote here in California?
Yeah, I always quote 2 to 2.5%. That's what I tell my buyers. I just use whole numbers. So 500K, house normally about 10 grand to close for a VA loan.
And I think we're fortunate here in California. For the most part, we have lower closing costs, not significantly, but lower than a lot of areas. You get into attorney states, it can be higher. Shanequa, there was something that you hinted at there. In Texas, if you have a disabled veteran, what is keeping their closing costs lower? What is the benefit? And I know this isn't exclusive to Texas, but most every state has benefits for disabled veterans. And if you're disabled, this is something that you would want to know going in. But what's the benefit in Texas at closing? And is it just closing costs? Is it taxes? What does it look like?
Since we're talking about the houses, if you're a 100% disabled veteran, you won't pay any property taxes. So 0 property taxes. And that's what keeps the closing costs down a lot. If you have a good lender, like the ones from Vetted VA, they automatically file the exemption and everything with the county. So you don't have to pay the property taxes at closing. But if you get an outside lender, a lot of times they don't want to go through that extra headache. So you're going to be paying, even though you should be paying 2%, you're going to be paying 3%.
And just kind of to follow up on that, every state there is going to be different. One of the things that Vetted VA has taken the charge on is lobbying these states to make it more advantageous and more beneficial to veteran borrowers. Nicholas, was it Maryland or was it Virginia that was one of the first that
Maryland.
they automatically? So is it Maryland? How does it work
Yes.
for disabled vets in Maryland?
Yeah, so in Maryland now, if it used to be prior to that, if you were, you had to wait until you actually took ownership of the property. And then once you took ownership of the property, then you would be able to file your disability paperwork with the state that shows you're 100% exempt from property taxes. So what happened is parts of Maryland have a very, very high property taxes. I think we're 5th or 6th in the country. And so, you have someone buys an $800,000 home that comes down to, about $7,000 a year in property taxes. That's an additional $4,000 or $5,000 that they may need to be setting aside for closing, that they're just going to get reimbursed to them in a matter of a couple months once they file the paperwork with the state of Maryland, and Maryland says, hey, yes, you are disabled, and since you own the property, now we can apply this to you. So AIM did a great job of leading the cause for that and getting that passed in Maryland. And I know there's a bill currently in the chamber for Virginia as well. So hopefully we see that follow up shortly.
And that is something that in a perfect world, 3 to 5 years from now, all of the disabled veteran benefits are able to be realized at closing and going through that underwriting process. Jeff, how about you explain for us here in California? First of all, we have some of the least beneficial benefits for disabled vets, but we don't have that benefit right now. You are going to go through underwriting with normal property taxes and realize the benefit after and potentially get a refund. But what does the benefit to a disabled veteran look like for us here in California?
It's unfortunately, it's not very much. So it goes off of income, and it's really off the cost. It's about $100 grand off the top. So it's not 100, even if you're, 100%, they're not waiving property tax here. It's a little, you do get some off the top, but it's not a lot. So once, go through the process, you can go to your county supervisor's office and submit the paperwork. But what is it? 140 grand? I just don't want to shut out numbers, but it's not a lot. It's not much.
Well, just look, in your best case scenario, you're going to get $100,000 taken off the value of your home. In California, your state tax, property tax is 1% with all your local stuff. We estimate 1.25, could be a little lower, could be a little bit higher. Let's say you're at 1.25 and you get $100,000 taken off the top. You save $1,250. It's $100 on your monthly payment. Nothing to sneeze at, but also nothing amazing. Whereas Shanequa, if you buy a $400,000 home in Texas and you're at like a 2.5% tax rate, that's $10,000 a year. That 100% disabled veteran, they don't pay any property taxes?
0. They don't pay any property taxes.
So as if we needed more reasons for Californians to leave and move to Texas. If we got disabled veterans are going to go, I ain't buying in California, I'm going to Texas.
Yeah.
Well, in Texas, with Houston, we have different types of property taxes. It consists of mud, like PIDs, PUDs. So most of the time, if it's in the mud, municipal utility district, no property taxes.
So again, this is a tough topic to cover in this situation. And this isn't necessarily a mistake in the home buying process, but if you do have a disability rating, you want to know and deal with a loan officer that deals with veterans on a regular basis and knows how your state handles this, because it does vary greatly from state to state what your benefit is and when you get to realize that benefit and how that impacts what you need to be ready with at closing. Nicholas, Jeff, for those of us that are doing loans on a daily basis, and Shanequa is probably not all that different on the real estate side. One of the things I want to talk about, the biggest mistake or a big mistake that borrowers make is we send them a list for documentation, and we always want to make that list as short, sweet, and easy as possible. But many times we don't get back everything we're looking for. We don't get back exactly what we're looking for, or you get it in sort of crazy ways. Jeff, why don't you kind of walk us through why it is important to get your lender exactly what they're asking for?
So it kind of goes back to the pre-approval process too, right? So if you submit a good pre-approval, that list of items will be, less, right? So if you're submitting your bank statements and your income properly, those items, when you do get hit with the underwriter, will be less upfront. So it's a cleaner file and a cleaner process through underwriting. So when your lender, want to say like the lender isn't trying to be the bad guy. I know it's stressful, to get updated bank statements, pay stubs, especially when you get towards the end of the month. Say you do go into escrow, like the end of this month coming up, they're going to probably want updated information. So the sooner you get that information to your lender, the sooner it can go back in the file, the sooner the underwriter will look at it, the sooner we can close the loan. So there is a reason and intent for everything we do.
I would say 100% on that. And kind of following up on it, it is important that you do as good of a job as possible of getting that documentation over cleanly. There is a big complaint among loan officers, and cry us a river, but borrowers will take a picture from an angle like this with shadows on it, and it's skewed and it doesn't show the date. So to Jeff's point, we're not being a pain in the butt. The lenders and the underwriters have requirements of what this has to look like. It has to be legible, has to contain all of the information that we need. For the most part, it can't be a JPEG that you took with your phone. But the good news is your iPhone, your Android phone, both of them come with a scanner that will use that picture and do a great job of turning it into a PDF. So most people don't have scanners, and it's funny, the younger borrowers aren't like printing things is like completely foreign to them. So I would relate this also back to screenshots. Younger borrowers, that's to them, that's as good of a bank statement, right? I took a screenshot of what my balance was. And from a lender's perspective, never going to be okay. We need the full statement. If you need a printout of your activity to show that your earnest money deposit cleared your account, it needs to be a printout that can be tied back to your name, your account number, has a URL. So all of these things can sound crazy, but hopefully your lender is doing a good job of walking you through that and explaining why it's important to provide the documentation exactly as they're asking. And hopefully they're being clear, because on the flip side, I'm sure you guys, we've all seen the loan officer that goes, I need a pay stub. I need the tax return. And, we need to be very clear about what we're asking for. And it's also beneficial to help that borrower with the why. Some people don't care. They're like, just give me a list, give me the bullet points, I'll give it to you. Some people are like, well, why? It's like a 5-year-old. Why do I need that? And if you're that person, hopefully your loan officer can walk you through why it's necessary and what the benefit is of doing that up front. Nicholas, did you have a comment on that?
No, yeah, I 100% agree. I think the why is huge. I think that's one thing that early in my career I probably didn't do as good of a job of. It would be, hey, here's what we need. And then as I grew in my career, I think that's probably one of the things I changed the most of being like, hey, like this is why we need it, right? This is the reason behind it. And I think I've seen drastically that once you tell them why you need it, it drastically changes their mindset of getting this back to you, because they know that, okay, they're not just, jerking us around. Like, they know that we, that there's a reason for this need, right? Explaining the U.S. Patriot Act, why we have to source large deposits, and just giving them that explanation of why, instead of just like, hey, they just need it. Because I do feel like a lot of times, especially some of the the veteran community, when in lending, get put through a ringer, and unnecessarily so, especially from lenders who don't necessarily specialize in VA lending. So, I think it is probably the best thing is that I've changed, and I agree with 100%, Josh. It's just adding that why. It's it's a 5-minute phone call to save you probably 5 additional phone calls or email exchanges to get to the same resolution.
And it's an extra step on our part. And tell me what you guys think about this. I won't just call someone and give them the information anymore. I'm going to send the email out with the what and the why, and then follow up with a conversation. Because if we're relying, borrowers don't do this on a day-to-day basis. So it's not their responsibility to take perfect notes of what you requested them for, and then to know exactly what and why, and to get that back to you. So if we want a certain set of docs back, it is important that we ask explicitly and give it in writing where they can kind of see that. And then obviously follow up with the phone conversation and add that personal touch. Shanequa, sort of going to the real estate side, mistakes buyers make. One of the big ones is settling, and settling can mean a lot of things. It can mean settling for a condo when they were going to outgrow that, settling for a school district, settling for something that fit their price range but was a long commute. What do you see in terms of mistake-wise buyers making when they're looking at what their needs are today, tomorrow, and translating that into buying a home?
I've noticed a lot of buyers, they kind of overestimate what their money can buy. So it's not so much that they're settling, it's just that what they want in their price range, they can't get. So I tell them, I'm like, you can buy this, but buyer's remorse is a real thing. Will you be happy with this? I know you wanted the big yard with the pool and the outdoor barbecue, but you can't get it. Are you okay with just getting, the house that's in your price range? And most of them, after they look at houses, a lot of houses, they see that, I really can't get everything I wanted.
Well, you absolutely hit the nail on the head. Buyer's remorse is 100% a real thing. And sometimes you can't tell the buyer on the front end, like, are you sure you're thinking this all the way through? I've got a couple of examples recently of buyer's remorse. Do you have an example maybe of a client who thought they were going to be okay with a certain aspect of a home, made that big purchase, and then found out that maybe they should have gone a different direction?
I don't have an example of that scenario, but I have talked a lot of buyers, just confirmation to let them know. Like, I have a buyer right now. She specifically wants a certain type of house by a certain builder, and she was gonna buy a different model because the sales rep was pushing her. You're like, this is a good deal. You got close to what you want. I had to take her to a side after he left and like, this is not the house that you've been wanting. So will you be happy with this? And she was like, no. It was a longer conversation, but that was just the cliff notes.
Absolutely. The best example that I have here for us in Southern California, a lot of clients, affordability is difficult right now. So they're looking further inland for homes that will meet the payments and what they qualify for. Well, I've had 2 separate clients in the last 2 years that bought out in the Victorville area. Nothing wrong with buying in Victorville. They got beautiful homes. They were very happy on closing day when they got their keys to their nice homes. Well, both of them worked in Los Angeles County. And both of them within 6 months were calling me and asking, what do I qualify if I sell this? And fortunately, a year or so ago, homes were appreciating fairly rapidly. So they had made a little bit of money and were able to get out. One was able to buy closer to their job. The other one wasn't. But those commutes are no joke. So whether it be a commute, a school district, certain amenities, things that you want or need, it's important to not just think about today. The home process, we talked closing costs, even with the 0 down, are 2 to 4%, depending on where you're located. But Shanequa, if I buy the wrong home, what does it cost me to get out of that?
A lot. You're looking at another Ooh. Well, the problem with I don't want to say it's a problem, but with the VA home loans, you're buying, let's just say, for instance, you're buying $100,000 house. You're not putting anything down. So, like when you go to sell it a year from now, you're basically selling it at close to the same price of what you paid for it. You got to add in 6% realtor commission fees, 2% closing costs. So you're looking at least 8% to sell that house. So
Yeah,
you might come to the table with money if you want to get out of it that bad.
Yeah. So for a borrower putting 10, 15, 20% down, it can be painful that if they have to sell, but nothing like a veteran who comes in with zero down. You may be stuck there for a while. You mentioned, hey, you can bring some money to the table. If you don't have that money, you may have to stay in a home that doesn't work and fit your needs. We have a comment here. It's not a question, but one of the viewers tonight says, yes, commutes are huge, especially in areas where it snows. So Southern California, I've never thought of it. I've thought about our horrible freeway systems and a commute that can be 70 miles that at midnight you can make in an hour, no problem. That is 3 hours, 3.5 hours during rush hour. But I can only imagine you get to some of these areas where snow can probably double and triple commute times. And if you buy in June, it could be easy to overlook that. So just a long way of saying, think through everything about that purchase. Think about what your family looks like today. Think about, is your job likely to transfer you? You know, a lot of parts of the country, Jeff, I'm speaking for you here in Southern California, we don't deal with as many active duty. We don't have a lot of military installations left in Southern California. But when you're active duty, the moving may not be your choice or your option. So those are things that we need to take into consideration. I always like to say, what does your family look like today? And what is it likely to look like 5 years from now, 3 years from now? Are you going to get married? Are you going to get divorced? That would change things. Both of those things would change things. Are you going to have kids, first kid, more kids? Hopefully you as a buyer are thinking this through, but those are things that are really important to consider. The career, is your job going to move you away? Some people, they work for a local company. They've worked there for 20 years. The odds of them needing to move out of the area for a job are very low. Other people, they get bounced around every 3 or 4 years. So it's important to think about where you are today, where you're likely to be in the future, because, you know, if you get historically, we've averaged for the last 70 years, 4.7% appreciation nationwide. Now, we just came off of 3 or 4 years of the biggest appreciation we've ever seen. So it would be reasonable to think we might see more moderate levels of appreciation going forward. If you put zero down and you need 6, 7, 8% just to sell, it could take 3, 4, 5 years just to get back to break even. So something very important to consider. We also had a question here. So what is the effect of newly constructed versus an older house to the lender or realtor? Would a lender or realtor prefer the buyer to buy either a newly constructed house or an old house? So before I let you and Nick answer this, Shanequa, why don't you tell us from your perspective what the difference is, and do you even care if your buyer buys a newly constructed home or an existing home?
I personally, it doesn't matter to me, but I try to guide them on whether they should buy a new construction or a pre-existing house, depending on what they want. Some buyers, they don't want a roof older than 5 years. They want everything brand new. They want the house freshly painted. So I tell them, you're going to have to go with new construction for that. But it has its pros and cons, because new construction is more expensive. Price per square feet is more expensive than a pre-existing house. So you're going to trade off everything new or the size.
And you said something that's really important there. The effective age of the home is what's really important. You know, if you buy a home that was built 5 years ago, is that really any different than one that was built last year? Probably not. If you buy one that was built 50 years ago, it could be very different, or it could have been built 50 years ago and completely remodeled with a, you know, down to the studs renovation. So those are the important things that you want to look at from that end in terms of looking forward. What are my likely maintenance costs? What are my utility costs? I mean, that's one of the big differences. Again, we're spoiled. I'm in Southern California. We don't get really hot. We don't get really cold unless you get out in that Victorville high desert area. So it can be a big difference in areas where you have extremes in temperature in both your heating and cooling costs and what that means for you on a monthly basis. So we know what that mortgage payment is going to be, but a newer home may be more beneficial in terms of your utility costs, could be cheaper to insure. If you're in, with Shanequa, with you guys there in Houston, you get hurricanes and all that fun stuff. I would assume that something built to the new storm codes would be cheaper to insure than a 40, 50-year-old home. Is that correct?
It's correct. And also the new construction houses, they're not being built in flood zones. So if you don't want to be in a flood zone, just look at new construction house.
So that's funny. So I want to get that question answered. So Nick, Jeff, hold your thoughts on whether your mortgage lender cares and whether it makes a difference. But let's talk about insurance. I don't know about you guys, but do you see your buyers? I mean, insurance is like the last thing. I have a client right now. We're supposed to close in 7 days. I've been asking for a week. Hey, do you have your insurance lined up? And they just got it lined up today. So things like a flood zone for us in Southern California, fire hazard areas. What are you guys seeing along those lines?
In regards to insurance, it's just everything's different. The faster you get insurance, the faster you're going to know the premiums up front. So that it goes back to your closing costs and how much we got to collect. So you got to plan homeowners insurance. A single family is about $110, $120 a month. It gets cheaper if you get a condo, but as soon as you get your insurance policy, the better. So you know how much that's going to cost you. So if you're going to find out if you're in a flood zone, if you need earthquake insurance, any other different types of insurance, right away.
And what I would say, the mistake is not doing it right away.
Right away.
If you have a contract, there is no benefit in waiting, and there are many potential problems that can come from you waiting to line up your insurance. We've seen just with inflation over the last couple of years, construction costs are way up. So homeowners insurance is up, depending on where you're at, 10, 20, 30% over what it was a few years ago. Jeff, we're lucky here in California. You mentioned $100, $120 a month. Well, previously we would have said $70 or $80 a month. And now we're up, most premiums are well over $100 a month. Nick, how does that compare to you in Maryland? Do you see higher insurance premiums?
Yeah. So, it kind of depends. I mean, I'm in DC. So, you kind of you go from everything from your 1900 brick row home to could be the same insurance as a 3,000 square foot home in Northern Virginia, a little further down. How close is it to a school? How close is it to a fire station? How close is it to a fire hydrant if it's a row home in DC? So there's so much that goes into it. I mean, we do our best to try to give a pretty fair equation. I think it ranges from, usually about 100, 150. But, I had one that, I would have had no clue, but their insurance was like $4,000 because of where it was located, every attribute that went into that house. Up front, we had said 1,800 being conservative because it was a larger home and it was a little bit out there. But, they came back like, oh my God, like our payments changed so much. I was like, well, it's your insurance. Like, your insurance is much higher. And, we do our best to estimate. But at the end of the day, like we're not insurance professionals. All we can do is estimate to the best of our ability. And this, I know for us specifically, when we send out our, first email to our client, their insurance is due within 5 days of them going under contract. So we put an actual hard due date, like, hey, this is due by this date. And if that's going to be a problem, let us know. But, for those exact reasons, because we want to make sure that as numbers are being updated, as things are going along, that we're accurately showing what their payment's going to be, and that they also are aware of what their closing costs and payment will be.
Love it.
Sorry, let me fire zone too. So forgot about fire zone in California. So
it's a very unpleasant thing when we're impacted by them, because it doesn't. I had one a few years ago, Jeff. It tripled what we would have been expecting in a non-fire hazard area. Yeah,
you're going from $1,200 a year to $4,000 very, very easily, right? And not knowing for a fire zone. I closed the house by U70. It was right out U70, and they got hit with being in a fire zone. So they knew it. I didn't know it. They weren't shocked. They're like, "Oh yeah, we know. We're expecting it." I was like, "Oh, I'm very happy you're not upset at me." Because
we don't have to worry about it. Like there's very limited flood zones in the DMV area that it doesn't come up too much, luckily. But it's one of those ones where, especially like when you first see it, you're like, "Oh wow, like this this is going to be an impact."
Let's circle back. I don't want to ignore the question that we had from a lender's perspective. do they have a preference? Do they care at all about the age of the home, new construction versus existing home?
Not really. No, I mean, I think it's just a matter of, there's if it's a VA, I mean, they have to be, the builder has to be VA certified and all that. So generally speaking, if it's a Lennar Homes, Ryan Homes, if it's a major cross country home builder, they tend to have all their ducks in a row correctly for what's necessary for VA. But sometimes when you get into those niches of home builders who are building their first, second, third home or custom home, those are the ones where, I'd say it's just making sure that you're working with a party that understands of the extra stuff that has to be done up front for a construction to be approved on the VA side in terms of the builder having to be VA approved. But preferentially speaking between, what type of home they buy, no, I mean, it's to Shanequa's point, it's what the veteran or client wants.
Can I say something about the insurance again? I know we passed that, but
no, go ahead.
The buyers, they actually can. It's when they go through their option period, due diligence period, inspection period. It's called something different in each state. They can get what's called a clue report, and that shows if any claims have been filed against the house. And while they're doing that, they can just get their insurance quote at the same time. Kill two birds with one stone.
And what's the benefit, or what is that clue report? What information does that provide to your buyer?
Because the seller is supposed to give us what's called a seller's disclosure, and that goes into detail about what problems the house has had. But not every buyer tells the truth. So not every seller tells the truth. Once you get that clue report, you can see, this had a kitchen fire that was never disclosed on the seller's disclosure. It was a roof repair or a roof claim, yes.
And it sounds crazy, but those past claims can impact what you're going to pay for insurance. So it's definitely another reason why you want to move that front loaded, put it towards the front end of the transaction, so that if there was a water damage claim, there was a flood and the insurers don't like it. I mean, I've literally had a property where we had to go to 6 insurers before anyone would ever cover it. It was something that had multiple flood claims, and that was probably the previous owner's problem. If you get 2, 3, 4 flood claims, you're probably doing something wrong with how you're living. But at that point, the insurers are like, we don't want any part of that one.
I had a buyer who they got the clue report, and it showed that there was roof damage, I guess hail or something, and the insurance company already paid them out for the claim to the seller. So the roof needed to be replaced, and the buyer was like, well, they can't move forward because they wouldn't be able to get a new roof through the insurance company because they already paid the sellers, and the sellers spent the money for something else.
You hear stories all the time. You're just like, what are people thinking? Just craziness. But actually, we have a follow-up to that question, and I like this. It's going to take us in a good direction here. The question was in relation to seller incentives in case of the new construction. So guys, Nicholas, Jeffrey, why don't you walk us through this? Because what I would always say prior to interest rates turning up in early 2022, I would welcome you. Most builders will require you to get pre-approved with their lender, and they're going to make an offer, and they're going to give you incentives because they want control of that transaction. Normally, their pricing, their rates, their terms were so bad that the incentive was not enough of an offset. Now, I don't know about you guys, but the builders here, I mean, Jeffrey, you're in my market here in Southern California. Builders want control. They are offering big incentives. They're buying forward commitment on those loans that they know they're going to be delivering a bulk at a certain rate and loan amount. So why don't you guys talk to us about what that looks like? And does the lender care about builder incentives if they're going to finance with you? Or is there a benefit above and beyond just the terms of the loan in working with the builder's lender?
You want to start, Josh?
You can go start. Yeah.
I mean, so I'm with you, Josh. Yeah, I mean, before the 2022, and even still to this day, I tell everyone is like, look, they're going to make you talk to their lender. They always do. That's the way the builders work, and that's perfectly fine. And for us, I find it very helpful. I say, look, go get a fee sheet from them, go get a full breakdown, and then send that to me. And I'll tell you if it's smoke and mirrors, like you had mentioned before. And there's many times that would be the case where it's like, hey, like, yeah, like that's great. They're giving you a $15,000 credit, but they're charging you a 0.5% higher interest rate, and then they're charging you 1% in fees for that same situation. So you're not really getting any incentive. They're just masking it to look like you're getting an incentive. Now, I mean, and then the flip side is that there are times where you'd be like, hey, look, like that's a phenomenal deal. They're giving you something that no one's going to be able to match outside of the builder's lender, and you need to lock it up and take it. And, you know, hope everything works out. If something falls through, call us, you know, in the future, call us. You know, I try to tell my clients all the time is like, look, like they're going to help you with the first one, but they're never going to help you again because they're there for the first loan and they're there for nothing else after. So if we can help you throughout the process, that's great because, you know, we'd like to help you in the future when you want to refinance or do something that isn't new construction. But it certainly in most recent times, I have seen that the incentives are something like you had mentioned, Josh. I mean, they want to control that vertical. They've got those forward deliveries. They're more on the hook for that construction loan than they are on the mortgage-backed security piece of it. So they're definitely going to drive incentives. But I've also surprisingly seen 2 new constructions in the past 6 months or 3 months rather, where they gave the same incentive if they went with an outside lender, which I had never seen before. So, you know, I think it's just something where, you know, each is a case by case, and you should definitely get a quote from the builder and get a quote from whomever it was that you were working with before. Compare the two. And I know most folks on whether they're a broker, whether they're retail, anyone that's not the builder's lender, they're going to be pretty straight up with you and say, hey, this is the best deal, take it, or, you know, it's smoke and mirrors.
Yeah.
So let's transition from there, because one of the absolute biggest mistakes that you can make, approximately 75% of buyers make this mistake, which is to go with the first lender you talk to and never compare terms with anyone else. So, you know, self-serving, I know that I am awesome and I am the best option for every borrower I talk to. So if you talk to me, if you talk to Jeffrey, if you talk to Nicholas, you don't need to shop or talk to another lender. But seriously, there's no way for you to know that without talking to at least one other lender. It would be like marrying the first girl or guy you go out on a date with. Could it work out? It could, but it's not advisable because you have nothing to compare it to. Jeffrey, you have any thoughts or ideas? What do you talk to, or what do you advise someone when they're very early in the process? I mean, for me, I'm not going to tell someone they should go shop when we're talking, but if they're asking about that process, I certainly have some advice. What are your thoughts on that?
Yeah, Sam, more of the same. Just, you know, I always bring it back to buying a car, right? Kind of keep things simple. When you bought your car, you went to several dealerships, you know, you went to your bank, you went to the dealership, talked about financing, looked at everything. You know, why don't you do that with your mortgage? You know, how do you know you're getting your best deal if you just submitted the application through a bank online, bank of choice online? So how do you know? And then just the education and purpose of, like, not all lenders are created equal, and not all lenders can do your left and right lateral limit. So what type of loan it is matters, and then what down payment is. There's so many variables with a mortgage, so it's so critical to shop what's going on, and who can actually do the loan and close the loan is more important.
Nicholas, how about you? If someone's talking to you about shopping, or they've talked to you and they say, I'm going to talk to this other lender, how does that conversation go? How do you advise them?
Yeah, I always say, look, I do think that we're priced very competitively, and, you know, myself, I'm a broker, so, you know, we are actively looking at pricing amongst the lenders that we sign up with. So I do advise and tell them a little bit about that. We have actively shopped your loan, but at the same time, that doesn't mean that you shouldn't also talk to another lender and take a look at it and see what they're able to offer. And I tell everyone, like, hey, if you find a better deal, just let us know. You know, I'm happy to take it to our team and see if we can match or beat it. You know, and I think the biggest piece that I try to present to all my clients is, if you want to compare pricing, just make sure you do it on the same day, or, you know, call the other lender back, whether it's me or you start it with the other lender, because pricing is so volatile, especially in the market that we're in today, where someone could have gotten a rate a week ago and it could easily be a quarter point difference between now and what it was last Wednesday. And they may look, oh, wow, like Nick was a quarter point higher. Well, no, like that was what our rate was last week. You know, it differs. So trying to always emphasize that if you are going to shop around, just try and make sure that you do your best to get the quotes on the same day, to make sure you're getting the most accurate quote in comparison.
It's a really big mistake. Shopping on different days and saying, oh, I called this lender a week later and they were better. Well, the first lender you talked to might also be amazingly better. You can't attribute market movement to a lender being better. So if you're going to shop with multiple, like you said, and I wouldn't say just in the same day, try and get those quotes within a few hours of each other. You know, we've been in a super volatile market the last few weeks with multiple reprices throughout the day. I didn't mean to cut you off, Jeff. You had something to add?
No. And then talk about that, the interest rate. I think the average consumer gets so focused on the interest rate. So, hey, I got a 6, I got a 5.75. And then I always tell people, what would you do to get that rate? So, hey, you're at 5.75, I'm at 5.875, you know, but they charge you $3,000 in points to get down to that. So, hey, yes, I'm higher, but it's going to cost less to close a loan. And the education and training parts of what explaining a LE review, saying, hey, this is what they charge you, this is what I charge you. Yes, technically I'm higher, but if you gave me the $3,000 in points, I can actually beat that by a quarter point. You know, if you're truly comparing apples to apples.
And just to follow up on that, one of the very first episodes we did here on Vetted VA Live, we did a deep dive, like a 40-minute walkthrough on the loan estimate. If you're interested, if you're in the market right now, I would highly advise go to the YouTube channel. Most of you are watching in Facebook, but the YouTube channel is a little easier to search. Go out there, like and subscribe. But when you find that video, it breaks it down, and it also explains that on a purchase, you guys, your lender, whether it's me, whether it's Nicholas, whether it's Jeffrey, we control your rate and your box A fees. The rest of the stuff is going to be the same no matter who you go to. So when you're shopping that's what you want to know. What are you charging me in box A and what is my interest rate? And then people go, well, what about box A says I've got a discount point, I've got an origination fee, I've got a processing fee, and I've got an admin fee. I don't know how you guys handle this, but I say, I don't care what they call it. They could call it a pink pony fee. All of the fees in there are essentially points. So if their points or whatever they want to call them add up to more than mine for the same rate, then my loan's cheaper. If they have a better rate with less fees, then they are cheaper. So really it's that box A in the loan estimate. Probably doesn't make any sense to you if you're watching this, you've never seen a loan estimate. Go back to that first episode. We break it down in depth. Shanequa, I always like to get a realtor's perspective on this because you're kind of a neutral third party. You're watching the lenders operate. What do you advise your clients when they're trying to determine who's the best lender for them?
But I always tell them to get 3 estimates, you know, but I doubt they can get those estimates because once we go into contract, they're sending me their CD asking me, did they get a good deal? And I'm like, what did the other lenders, say? But I tell them to look at, like you said, box A, because if they look at closing costs, a lot of lenders will, the closing costs will look lower because they lowball the property taxes or insurance. So that's how, like Jeff can be lower, but Nick, he's actually has a realistic insurance rate and property taxes.
No, it's funny that you mentioned that. Probably one of the best examples I have. About 3-4 years ago, we had a client. We locked his rate on a Friday. He's super happy. And he keeps asking, how do we get this lower? How do we get this lower? I said, once again, I'm a broker. I've shopped around. I've priced this with our best priced lender. I know this is very good and aggressive terms. I said, unless you want to pay more, we're not going to get that interest rate down. Well, sure enough, on Monday, he calls and he says, hey, need you to let my VA case number go. I got a better deal. Cool. No problem whatsoever. Send me over the loan estimate and we'll take a look at it. And if it's a better deal, I'll happily release the VA case number. Sure enough, comes over from, without naming the lender, the one that you can't avoid, that they have commercials and advertisements everywhere on the planet. And they're proud to tell you they're the biggest lender in the history of the world. Well, the kid in the call center was quoting a purchase with the current owner's property taxes. And the current owner had happened to own that home in California for about 50 years. Their property taxes were $125 a month. In California, we have Prop 13. So you can only have your property taxes increase 2% a year. But when that property sells, the buyer is going to pay taxes based off of the new purchase price. So our guy was looking, I think, $445 a month, and it was being quoted at $125. So he was paying a point for what we were giving him 0 points, and he was paying a 0.25% higher interest rate, but somehow the lender had convinced him he was going to save $275 a month. So it's really important that you know what you're looking at and that you're not just shopping on lowest rate. I will tell everyone your terms are very important, but when you're shopping, you should be looking at 3 things. So terms meaning rate and points that you're paying to get it. the knowledge and expertise of the person that you're talking to. Hopefully, from listening to Jeffrey, from listening to Nicholas, from seeing the people in the vetted VA community answer your detailed, specific, crazy questions that don't apply to a whole lot of loans, every lender is not created equally. You want to make sure that you're working someone with a high level of knowledge and expertise. And the third criteria that I like to advise people to put in there, make sure you have a good rapport with them. You could be talking to the best lender on the planet. Literally, if we knew the guy who had the crown, the girl who had the crown for the greatest loan officer on the planet, if they're a jerk, if they don't listen to you, they don't respond to you, you don't want to deal with that. So make sure they're cool. You have a good rapport with them. You have a good time talking with them. They're hearing you. They're answering your questions. They have knowledge and expertise. They're getting you honest, accurate answers. And then they have excellent terms. That's sort of my advice that I tell everyone if they're going to shop, because the biggest problems that I see, the ones that boomerang back, that they call me a week before closing, it's the ones that went with, well, this guy told me he could get a quarter lower than the 5 other people that I talked to. Like, well, there's nothing magic. Like, we shop the world. I don't know about you guys. We throw it into Loan Sifter. I can see the top 40 or 50 lenders on any program in any given day. If someone's outside of that, it's generally a sign that something is off there. But along those lines, borrowers always want to get the best terms, but something that I see fairly regularly is a suboptimal credit score. And what I mean by that is there's some tweaks that they could make to boost that score and possibly get better terms. What does that look like, Jeff, when you pull someone's credit, besides just looking at, hey, we've got a $300 car payment, we've got a $110 student loan and $50 a month on the credit card. What are you looking at, and what are you advising clients? What should they be expecting and hoping for when they're talking to a lender in terms of helping them get to the best deal?
So what credit is there? So when you pull a credit report on, we have CIC, you can run scenarios on there. So you can click on the little button and it'll show you like, hey, you can do this, this, and this, and it'll raise, 40 points, 30 points. And then, so when I do that and you go from maybe a 630 to 670, and then I read you pricing and you do get a quarter point, a half a point better, maybe that's a better deal. Maybe I do brief my client that says, hey, are you ready to go into escrow, soon? Or is this, a long-term plan, maybe a month, or, what's the ultimate goal? So we would probably start there, say, hey, I want to get into my house now. Well, you can qualify, let's do it. But if not, you're starting the pre-approval process, I can start playing with the numbers and running scenarios to help you out with your credit, to boost your credit X amount of points to give you a better deal.
And it comes up fairly often. I wouldn't say it's every month do we have a client that there's something that we can manipulate by paying down some debt and improving that score. But probably every couple months, there's someone that, versus using all of the money for down payment and closing costs, that we can pay a debt or two down and get that score boosted to the next tier. On a VA loan, the tiers are pretty wide. You want to, for the most part, get above 620, 640, even better, and then again above 680. But sometimes we have lenders that are giving incentives for getting from a 720 to a 740. So hopefully the lender that you're working with has that knowledge and ability and expertise and takes that time to go through it with you. So we like to keep these at about an hour. We're running about 53 minutes now. I know you guys have some places to go. But before we head out, I want to give each of you guys an opportunity to say any additional mistakes, tips, tricks, ideas that people watching at home can benefit from to make sure they're optimizing their process and come out with the best outcome for them and their families. Nicholas, you want to lead us off?
Yeah, no, I appreciate. Hopefully, everyone found some good information that was able to attend. I'm a big believer in just have a conversation. The first call with pretty much most good lenders, if you talk to someone and they say fill out an application, that's not who you want to work with. Okay. The first call with pretty much any really good mortgage broker, loan officer, is going to be a 20-30 minute phone call of learning what your goals are, to explain to you what the VA loan is, how we're going to help you, the process, what closing costs are, how much those are going to be, literally going through what I call a mortgage 101. And so, I highly recommend to anyone out there that is, whether you're 3 months out or a year out, have that thought process to just have that phone call earlier rather than later. It's not going to cost you anything but 20-30 minutes of your time with pretty much any loan officer out there that's worth anything.
Perfect. Shanequa?
I think it's a good idea if you're a buyer to start saving for those upfront costs, like earnest money deposits, option fees, inspections, appraisal surveys. Just because it's zero down don't mean you don't have to put up any money up front.
Awesome. Jeffrey, what are your thoughts?
The pre-approval process, I preach pre-approval, get pre-approved. That pre-approval process will hit a lot of points and go over the process of your loan. And then it'll help out with credit. If we do need to get a credit repair, help out with credit, what you qualify for. Getting a real pre-approval is where it's at, and do that sooner than later.
So that was what I was going to ask you. Is there such thing as too soon to talk to a lender and start that pre-approval process?
Absolutely. I would think no more. A year out is not. If you're shop, hey, I want to buy a year from now, do it a year out. Talk to the loan officer. Go through the steps. Don't be afraid of your credit pull. I tell clients the only reason you have a credit score is to buy a house, right? That's the only. I know you need it for other stuff, but like this is why you have a credit score is to buy a house. So don't be afraid to run your credit. We can do soft pulls that won't be a hard hit on your credit report, but a year out, it isn't, wouldn't be out of the case. It actually talk to the lender and see exactly where you're at. And then talking to the lender too about paying stuff off. So I got clients all the time saying, hey, I want to wait for you to run my credit because I'm going to take 10 grand and pay off my truck. I'm like, why are you doing that? Like, let me look at it first, and then maybe you should pay off this, and this, and keep your truck. It goes back to the DTI ratio. Maybe that's not your best move at this time. So if you want your truck paid off, pay off your truck, what I mean? But if you're trying to buy a house, you listen to a professional.
So piggybacking off of that, what I like to leave everyone with tonight would be the fact that it is important that you're working with knowledgeable experts, both on the real estate and on the mortgage side. And it's not to say that only experts in the vetted VA group who've been through the testing and education process are experts, because we all know really good VA loan officers, really good realtors with a VA background that understand the process. But it is a unique loan program. There's nothing magical about it or difficult about it where a loan officer can't figure it out. But you don't know if you have one of those unique circumstances that requires an encyclopedic knowledge of the VA handbook until you get into it. So you saw 3, 4, 5, 6 points that these guys made tonight that would be important if that impacted you, that your lender know that. And then it's almost equally important on the realtor side that your realtor have that knowledge and expertise of the program, because there are biases out there among sellers and other agents against the VA program, and they're wrong. They're dead wrong. So you need to be working with someone that understands this program, can explain it, and can sell your offer so that you are at least on an even playing field with the other offers that are coming in. So we have a cheat code. You can go to the map. You can find someone in your area. The realtor coverage isn't nearly as wide as the lenders, and realtors are much more local than lenders. So if you're in an area that the map doesn't have great coverage at, ask. Let's see if we can find someone that can help you, because it is important that you have an advocate on the real estate side for you as a veteran using your VA benefit that you earned so well. So again, guys, gals, I appreciate you being here. I appreciate you sharing your expertise. Appreciate those of you watching at home. Hopefully this was helpful. You got some tips and tricks that can put you in a better place when you go to write an offer on your home and impact your family's financial health over the long haul. We'll be back again next Tuesday, every Tuesday, 5 o'clock Pacific, 8 o'clock Eastern. I'm always bad at the translation in between on the flyover states, so you guys will have to do that yourselves. But again, thanks for joining us tonight, and we'll see you guys next week.
Thank you.